is.
We still have a lot on lock today, and also some more giveaways. We have a giveaway at 2 Eastern and a giveaway at 5 Eastern, and the prizes are only going to get bigger, so we hope you stay with us throughout the day. I'm going to let you tee up Mr. Bigalow.
All right.
Bigelow's a very good friend of mine. I've known him for a long time, but I'm going to let you do the intro because I know he's special to you as well.
Absolutely. Well, once again, just a great day so far, and we have a super speaker here. Steve Bigalow is with us, and he's going to be giving a presentation on T-line trading and volatile markets. Now, Steve's been associated with Westmark Trading for about 15 years, and I've personally known and worked with Steve over the past 10 years doing webinars and presentations, and he's just first class. He's been advising professional traders, money managers, mutual funds, and hedge funds for many years, and is affectionately known throughout the industry as the pro's pro. However, he's probably best known for his tireless work on candlestick pattern analysis and combining these with conventional methods for extracting maximum opportunity out of the markets. That's how I got to know Steve. I use his techniques when I trade, and I'm delighted that he's here. And in his presentation today, he's going to be talking about optimal selling points in oversold conditions, early alerts when the trend is about to turn against you, and maximizing your opportunities to protect your gains. This is really what Steve is all about, and we're delighted to have him. Steve, welcome. It's great to see you.
Thank you very much, Raleigh. Thank you, Jeanette.
Hey, Steve. Good to have you.
All right, let me see how I set up my screen here. That's not the one. How do I get over to...
Can you drag your PowerPoint over to this one? That is the most compelling slide I've ever seen.
Okay.
I see it. You're all good.
Okay.
Okay.
All right.
You have till the top of the hour, so take it away.
Okay. So I guess the first thing, can you see if we do a questionnaire, how many people have seen my presentations in the past, just so I know how much time to spend on each screen?
Yeah, they'll, okay, so we've got a yes, I have, I've seen a few, yes, weekly, no, 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 yes, me, no, never, no, yep, no, fresh.
All right. Okay, well, thank you, everybody, for having me here today. I've been doing candlesticks for the last, I hate to say how many decades now, by accident. And it was I was a stockbroker for 8 years in the late 70s, early 80s. Got out of the business because I realized the brokerage firms had no more idea about what prices or how prices moved up or down as anybody else. So through the years, I've learned candlestick analysis. When I started picking it up because somebody gave me some antiquated information on candlesticks, the thing that kept striking me most across the head was, this all makes sense. So out of the 50 or 60 signals, there's 12 major signals, and this is basically the bread and butter, the bricks and mortar of candlestick analysis. And so what I discovered was that once you learn the 12 major signals, you pretty much has a strong grasp of what makes prices move. Because the Japanese race traders not only illustrated these 12 major signals. Now, these are the 12 major signals out of the 50 or 60 signals in candlestick analysis. The Japanese race traders over the last 400 years also would explain what the psychology was that created those reversal signals. So being able to visually recognize them and understand what the psychology was, you now had a grasp of when there was reversals in the markets as somebody that had been trading in the markets for 50 years. So here's the T-line. The T-line is the 8 exponential moving average. There's a very simple rule. If you see a candlestick buy signal and a close above the T-line, you've got an extremely high probability that an uptrend is in progress. And you can stay long until you see a candlestick sell signal and a close back below the T-line. Now, as you can see, my charts are relatively simple. I've got the 200 and the 50 simple moving average, or daily simple moving averages on the chart. That's not because we use those moving averages to make our decisions. we use those moving averages to see what everybody else is doing, making their decisions at those levels. The T line is the 8 exponential moving average. Again, this is probably one of the most influential indicators that you're going to come across. Over the last 40 or 50 years of, I guess 40 years anyways, of trading, this has been the most relevant indicator that I've come across. So it works both on the upside, a candlestick sell signal, and a close below the T line. You've got an extremely high probability a downtrend is in progress. So this is not rocket science. This is basically being able to utilize the trend. You're going to see sell signals, but without the combination of a candlestick sell signal and a close below the T line, you can stay long. So here's the simplicity of candlestick analysis. You can pretty much do a trend analysis using the signals, the patterns, stochastics. My stochastics are 1233, and then trend lines and different moving averages, only because we can analyze what's happening at those levels, what everybody else's decisions are. So here's my most important screen of this whole presentation. Jeanette Raleigh, if people have questions as we're going through, don't be afraid to blurt them out, and I'll try to answer them as quick as possible. But the T line acts like a natural support and resistance level of human nature, like a Fibonacci characteristic. So this is what is kind of the bread and butter of candlestick analysis. If the candlestick signals are the graphic depiction of what's going on in investor sentiment, and the T line is a natural support and resistance level of human nature, when you combine those two, you've got an extremely powerful trend analysis combination. So you can see how you can analyze. The first thing I do every morning before I put on trades is wanting to know which direction the market is going. So we can see there's your evening star signal and a close below the T line. You're in a downtrend until you see the morning star signal and a close back up above the T line. You can stay long until you see the shooting star and a close below the T line. So this is not rocket science. This is basically analyzing what human nature normally does. Now, people are saying, well, how did you know to start going short up here when the big market crash started? We didn't. We just knew that because you were closing below the T line, you were probably in a downtrend. It may have supported here, it may have supported here. It just put us in the right position at the right time because it was immediately identifying which direction the market was going. So that's what happened. Notice how you could stay short. There was times you could cover your short. It failed the T line until we got down into this area. Now, the nice thing about candlestick analysis is there are reversal signals that are very high probability. I mean, extremely high probability. That's why we're looking at them 400 years later. This is what we call a McMuffin, which is obviously not a Japanese candlestick or a Japanese race traders terminology. But when you have a big down day, a doji day is a day of indecision where it opens and closes at the same level. And then the third day closes more than halfway up this candle. And in this case, it also closed above the T line. That's your morning star signal, one of the 12 major signals. The next day, it did a doji type day. And we have a very simple doji rule, which is a high probability result. The price is usually going to move in the direction how they open after the doji. So when it opened positive, we knew we probably had a doji sandwich, which would be this candle was going to be the same magnitude as this candle, which told us we're well up above the T line, which started our uptrend. Now we call it a McMuffin because you got a morning star signal followed by a doji sandwich, or your morning sandwich, the McMuffin. But this was an extremely high probability reversal. So this is what cuts through emotions of trading. When we saw this, notice what this signal did, that it didn't do all the way down. We had a buy signal and a close above the T line. That told us there was a change of investor sentiment. So again, the Morningstar signal followed by a doji sandwich is one of the strongest reversal signals. We can use the T line to tell us what's going on in investor sentiment. In this case, the Dow is doing a wedge. Notice that it did a kind of an indecisive day gap up. That's called your best friend. You had the prospects of the best friend signal gapping up above the previous day's above the breakout and above the T line. That told us we had an uptrend. Look at our J-hook pattern. That's another major candlestick pattern. And notice what it didn't do. They couldn't close this below the T line. That told us that if we were taking profits here and we noticed that they were doing indecisive trading here, when they started back up, we knew that this wave right here was probably going to be the same magnitude as this wave right here. So this is very simple. You use the T line as an uptrend. This is the little green line is what we call the 3T line. When you see a sell signal or close below the T line, the 3T line kind of acts as an additional confirmation that the bears have taken control. Let's see, I guess I can put up the, trying to see if there's a chat. But I guess not. Okay. Now I got to get rid of that. So here's the simple observations the Japanese rice traders provided for us. Where do most people buy? They buy exuberantly at the top. Where do most people sell? They panic sell at the bottom. This is also illustrated by the T line. Remember, I said if you see a buy signal and a close above the T line, you can stay long until you see a sell signal and a close back below the T line. With the caveat that the further away you move from the T line, the higher the probability it's going to come back and test it. So we'd be taking profits up in here because you're in the overbought condition, and then it started trading back below, traded lower. Remember our doji rule. It opens lower and started trading down. Where was it heading to? Back to the T line. So you saw that in Tesla not too long ago. Raleigh, Jeanette.
Yes.
Are we getting any questions? That's what
yeah, we sure are. I got some questions that are popping in here. The first question was, is the exponential moving average the 8-day average?
Yes, the 8. It's not the 8-day, it's just the 8. Now remember, candlestick analysis is the graphic depiction of everybody buying and selling during a specific time frame. We could be looking at the 1 minute, 5 minute, 10-minute chart, or the daily, weekly, or monthly. So it's the 8 exponential moving average. Yeah, so if you're on a daily chart, it's the 8-day exponential moving average.
I got you. And then there's several questions here about what is the light green line?
The light green line, again, was the 3T line. And that works effectively in two ways. The further away you move from the T line, the more effective the 3T line becomes. And or if you see a buy signal, and in this case it's not on here, if you see a buy signal or close above the T line, you get that little added confirmation that if the 3T line comes up through the T line, that's more confirmation that the bulls have taken control.
Okay, and then the other question that's come up is more of a request, Steve. Is there a way that you can have the cursor on the screen so people can follow a little bit more easily where you're talking about on the screen? It's like we don't see a cursor or anything there.
Oh, I didn't know that. I do have, how do I get the cursor on the screen?
Let's see here. If you go to the top, I think there's an annotation function there, or you see where you can click the mouse.
Okay, annotate. Sorry about that. So, okay, so again, the simple rule with the Japanese rice traders say, where do most people buy? They buy exuberantly at the top. Look what happened in Tesla last month. Look what was happening. Well, this is human nature. They started gapping it up. Where do most people buy? They buy exuberantly at the top. They gapped it up. They gapped it up again. So what is the process for being alerted to the fact that we're that far away from the T-line, what's that tell you about human nature? More than likely, they're going to start taking profits. So how do we know how to take profits up here versus down here, where when it did exactly what we expected to do, it came right back to the T-line? Very simple. If the alert is that we're way up here and we can see that we're that far away from the T-line, we simply move to the 10-minute chart. And we can stay long, we can set our stops, stay long, set our stops, stay long, set our stops. We're stopped out here. So remember, this is a 10-minute chart, which looks just the same as any other time frame. So we were out closing, had people closing out up here before it dropped 200 or 300 points by the end of the day. Again, this, I keep reiterating, this is not rocket science. This is just analyzing what the Japanese rice traders told us what normally happens in human nature. Now, you've got a lot of good speakers this week. They all probably have good trading programs. And even if you don't use candlestick analysis as your primary analysis, at least put the candlestick charts on your screen or on your charts, because you're going to see a lot more plainly what's happening in those price moves. So this is why candles or the T-line is so effective. Moving averages act like magnets. Why is that? Because if you're a big money manager and you like this stock and you finally got approval to go ahead and buy, where do you think you're going to buy? You're probably not going to buy until it comes back right to the 50-day moving average. That's because everybody and their brother is watching what's happening at these moving averages. We can see when the exact selling occurs. A bounce, where right back up to the 50, did a doji, an indecisive day, and closes below the T-line. What's that tell us? That if we bought long down here, we're closing out our position and can go short. But the magic of candlestick analysis, I shouldn't use the word magic, the logic of candlestick analysis is it acts like support and resistance, the T-line does, which tells us that we have it uses the T-line as a support and resistance level, which is a level that nobody has this on their chart. Statistically, nobody has the 8 exponential moving average. So I tell people, don't take my word for it. Throw the 8 exponential, the T-line, and watch how the candlestick buy signals constantly occur right at those levels. And again, these are levels that nobody else is watching. It's the natural support and resistance level of human nature. It also helps you with pattern confirmation, meaning if we see our best friend, bearish best friend, a doji gap down through the T-line, what's it tell us? We can stay short until we see a candlestick buy signal. Very simple. If we're buying down here, there's our doji gap down. Where do we take profits? Right here. Where do we buy back in? Well, look what happened right here, smack dab on the 50-day moving average that everybody else is watching. We're in the oversold area. This is what we call a bullish harami. In Western terminology, it's called the inside day. But a bullish harami tells us the selling has stopped. Then they gap it up, and that's one of the truisms about candlestick analysis. I've heard so many people being advised that you stay away from gaps because you don't know what's going on with the price moves when prices gap. Candlestick signals and gaps are going to produce the biggest profits for you because this signal told us exactly what was happening. They had stopped the selling. Gap up the next day told you that started the buying. We can see much more clearly where the buying has occurred. This is what we call a bobble breakout. That's a J-hook pattern. It comes up, it fails at the 50 and pulls back. And notice what the T-line did. Wouldn't let it close below the T-line. This is what we call a left-right combo. A doji followed by a bullish engulfing. We can be buying here. Where's the best place to buy? A buy signal in the oversold area. Where's the best place to buy a pattern breakout? When your stochastics are probably up here in the overbought area. So if this was kind of wave 1, we know wave 3 could bring us up into this range. There's a bobble breakout. Comes up, fails at the 50. What was our criteria or our confirming indicator? The fact that they brought it right back to the T line and started back up. I used to, if I got out here and it started back up, I'm thinking, oh man, before candlesticks came along, they weren't going to fool me. They weren't going to let me get, or have me get back in and then take some more profits back from me. Now I know what human nature does. I can be buying here knowing that I'm in the next price move. Where do I take profits? There's our dark cloud. Pulls back. Notice how indecisive this trading was on the pullback. The doji supports right on the T line. They start back up. What do I got now? Wave 1, wave 2, going into wave 3, which should be the same magnitude as wave 1. So this basically tells us what to do when we see pattern breakouts. Here's our fry pan bottom, one of the Japanese price trading patterns. It looks like a fry pan bottom. Where did it break out? Right about where this pattern started. How long do we stay in this trend? As long as it doesn't close back below the T line. Now, the reason this was significant for me was, what do most people do? Well, before candlesticks came along, I was just happier than a pig in doo-doo just to have a profit in a trade, let alone a big profit. So if I got up here after buying here, what am I thinking? Oh boy, I'd really look stupid if I didn't take profits and it turned around and went back in this direction. So that is the opposite of what you're supposed to be doing, which is basically cutting your losses short and let your profits run. This simple technique of using the T line after coming out of a pattern just gives you much higher probabilities that you're going to be in this uptrend till the maximum when it's time to start taking profits. There's our bobble breakout. How long do we stay in this one? As long as it doesn't close below the T line. So basically, the T line just improves your probabilities that once you see a reversal and a close below the T line, you can assume you're in a downtrend until you see the Morningstar signal buy right off the 50. You can assume you're in an uptrend until when? Until you start moving too far away from the T line and you see a sell signal. Where do you think it's going to come back to? Probably come back to test the T line. This is based upon the most consistent indicator in the world, human emotions. Prices do not move based upon fundamentals. Prices move based upon the perception of fundamentals. And candlestick analysis is just merely the graphic depiction of what's going on in investor sentiment, and using them just dramatically improves the probabilities that you're in the right direction at the right time. So again, all the graphics that we look at in candlestick analysis is just merely illustrating what the investor sentiment is telling us, or what the race traders told us investor sentiment was telling us. Where do most people buy? They buy exuberantly at the top. Where do they sell? They panic sell at the bottom. And that's how I became good at analyzing candlestick charts. Because as a stockbroker, I couldn't figure out, every time I recommended a stock to somebody because it was doing well, it would immediately turn around and go the other way. Or when it was so bad that I couldn't stand it anymore and I'd advise people to get out, as soon as we sold it, it'd go up. That's the normal human nature reaction. This also helps us identify when to get into high profit trade setups. There's your fry pan bottom. There's your strong breakout. So when do you take profits? Well, we got very simple applications of when to take profits. Look where we are up here. Look at this stock. And this was APT when the virus mask stuff came about. Went from 6 to about 40. So what becomes our indicator when to take profits? Well, it opened, It gapped up. I mean, that alone, when you see something gap up in the overbought condition, you start looking to take profits. So a very simple exit strategy. If it opens here and starts trading here, you put your stop right here. Because logic says if they come back down through the open, it's going to create some sort of candlestick sell signal. Why would we be putting stops up here? Because look how far away we are from the T line. Where do you think it eventually came back to? Right back down to the T line. Right now, this is a stock that we're still trading. As a matter of fact, I didn't know what they even did until yesterday, that it's a gaming or a gambling on gaming stocks. But look at everything that you can analyze in this chart. You're in the oversold area. Look at all the dojis down here. Lots of indecision. If you bought on this day, what's your reason to get back out? It didn't confirm. It closed back below the T line. This is where you cut your losses short and you let your profits run. Notice what happened on the next buy signal. They came right up to the 50, did selling, and notice what it did. Right smack dab on the T line. In this case, this dark green line is the 34 EMA, which works extremely well as what I call a secondary support and resistance level. But then notice what it did. There's your bobble breakout. Notice what happened up here. You could take profits up here when you saw it gapping up. Look how far away you are from the T line. Then notice what happened. Came right smack dab to the T line. And when I say that, that's to illustrate the point that nobody has the T line on their chart. And look where it moves to. Right there, right to the level of the T line. It acts like a natural support and resistance level. So what are we doing with it today? Right now, it's trading up here today. It's starting to move too far away from the T line. So we might take some profits up here. But again, this is all based upon common sense built into graphic depiction of what normally happens in human nature. Another one that we're in. Again, look at your fry pan bottom breakout, kind of your doji sandwich. So we're up here in the overbought area. Rhetorical question, why would you buy a stock that's already in the overbought area? Because if we can see it's coming out of a pattern, we know there's going to be more upside. And how long do we hold on to this? And until it closes below the T line. Now note what was happening right here. Again, this is the perfect illustration of every time they pulled this price back on a daily basis, what was acting as support? The T line, which once again, nobody has on their chart. It acts like that natural support and resistance level. So how long do you hold this? Well, if you took profits in here, you could be buying back here because you could see that it held the T line and your next pattern is starting to the upside. If you took profits here, there's your bearish engulfing signal. Is it going to head back this way? We don't know. But notice what happened. They still held the T line and then they came back up through this level.
Hey, Steve, it's Raleigh here. I just need to come in for a minute. For whatever reason, the cursor it gets frozen and it's very difficult to follow your presentation.
Okay.
So I'm wondering if we just it was a good recommendation, whether we should take a little technical time out here and see if we can get that working a little bit better.
Okay.
It moves occasionally, but then it's not following what you're obviously pointing at things, and it's not.
All right.
Numbers you're using in the stochastics?
My stochastics are 12.33. Now that's not anything set in stone. I just sat one night 40 years ago, 30 years ago, and said, all right, where do I set stochastics where the peaks and the valleys kind of coincide? And because I am a swing trader, I think the standard back when I started looking at candlesticks was 14.55, but that was a little bit too slow for the swing trading. So I use 1233. You can try that, and if it works for you, keep it. If you want something a little bit more refined, you can tweak it just as easily on your charts.
Okay. So before I go, could you move your cursor a little bit more? Because it seems to be a little, there you go. It's moving.
Okay.
Okay, brother. We're good. I'm going to let you go.
All right. Let me go back a few just to, all right. On this one, so I guess it wasn't working. So if you can see my cursor up here, when it opened positive and started trading positive, just simply put your stop right here, because logic says if something great is happening, it's going to continue right on up. If it comes back down after gapping up that far away from the T line, comes back down through that, the open, that's when the profit taking started. And the alert for that, again, was the distance we were from the T line. So, so there's some very simple common sense attributes to candlestick analysis. Everybody says, where do you put your stop loss? I'm told that you should set it at 3% or 5% or 7% below below the price. The answer to that is the market doesn't give a hoot where you bought it. What we're looking at is what is investor sentiment doing, and when does this investor sentiment change? So for years, I've heard people say, again, cut your losses short, let your profits run. They never tell you how to do it. It's all common sense with candlestick analysis. So if I had bought right here, which was my bobble breakout, expecting a high price move, if this had turned around and closed back below the T line, I had a completely different analysis. You close out the position. Again, the reason we could stay in this one is notice how the T line acts as a natural support and resistance level. And again, it acts like a natural support and resistance level because when they started selling off, where did they come back to? Right smack dab to the T line. And what I hope I'm illustrating is if nobody has the T line on their charts, it's picking a level that nobody's watching or nobody's prized to. The T line works very well. So we bought this one on the bobble breakout. It's worked very well. Right now it's trading up here somewhere, I think. And again, what's the fear factor most people have? That if they didn't take profits, they could give back all their profits, and boy, would they look stupid. I now can sleep very well at night knowing that if I see a buy signal confirming, as long as it doesn't close below the T line, I just stay long. So look at what happened to Beyond Meat yesterday. I don't know where it is today, but it came up, failed right here at the 200. There was a bearish engulfing signal. Came right back to the T line. This is what we call that doji sandwich. Bullish candle, doji, opens positive. In this case, not only did it open positive, but it gapped up right at the resistance level and it's going this direction. What's the anticipation? Wave 1, wave 2, wave 3. Again, this is not anything where you have to be a highly technical person. All you have to do is learn what the normal reaction or the normal price moves of human nature does for you. DLPH. Yesterday, this had a big price move. Remember what the Dow did yesterday? Dow was down 200 points. The bobble breakout is just a high probability trade setup. Where do you think your next likely target's going to be? Probably up here at the 200-day moving average. So again, the T line basically constantly puts the probabilities greatly in your favor. So if you're using the combination of candlestick signals, which tell you when there's been a reversal, either up or down, then you just go to the T line and use that to constantly put the price move or the trend where you don't have to worry about whether it's time to take profits. Is it zigzagging you out? As long as it stays above the T line, the probabilities are greatly in your favor. It's still moving in that direction.
Hey, Steve, well, I've got you here. If you don't mind, a couple of quick questions that have come in.
Okay.
And I think what people are very, very focused on your chart. And so the question that keeps on coming up is like, what kind of time period are you using? And is the EMA days or whatnot? And I think we need to make sure that people understand that the EMA it's an 8-period EMA. You happen to be using a daily chart, but could I be trading 15-minute charts with this?
Yes. Let me back up here a little bit. This chart, if I wanted to day trade, I could use maybe a combination of 1 minute, 5 minute, 10-minute chart. And it would look exactly like this. Nothing changes. I guess it is what they call fractal.
Okay.
That when I go from a daily chart to a 10-minute chart, it's going to look exactly the same. And again, it comes back to that one basis that investor sentiment is going to act the same way time after time. So it doesn't matter what time frame you're looking at.
Sure.
Now, when I'm swing trading, I'm using the daily chart because my positions are going to be anywhere from 2 to 10 trading days. If I was intraday trading, which you can do, if I'm intraday trading soybeans or cattle or the dollar, I'm using the 10-minute chart. And then what you can do is basically figure out what is the time frame that's most comfortable for you. If you're trading quite a bit, maybe using a combination of a 1 minute, 5 minute, 10-minute combination during the day. If you're only trading in and out maybe a couple of times a day, maybe use a 5 minute, 15-minute hourly chart.
Sure.
So you figure out the combination that works most effectively for your trading.
So it's an 8-period. Another question that's come up is how are you using the stochastic indicator in your decision-making process, Steve?
If you see a candlestick buy signal in the overbought condition, it doesn't mean very much. If you see a candlestick sell signal in the oversold condition, it doesn't mean very much. What you're looking for is a candlestick buy signal when your stochastics are in the oversold area. Let me see if I can find a more defined one. If I'm seeing there's my bullish engulfing signal in the oversold area. That is much more relevant. The Japanese race traders make it very simple. If you see a candlestick buy signal in an oversold condition, you're probably seeing a reversal. If you see a candlestick sell signal in an overbought condition, you're probably seeing selling.
Sure.
So it's again, everything that I discovered when I was learning candlestick analysis decades ago was this makes sense. It's just all common sense put into a graphic depiction. And there's a lot of times where you'll look at something and say, yeah, that's what you're supposed to do. I just never looked at it on a graphic basis before.
So what he's got, so what was I understand it, Steve, you've got some confirming signals there that are highly visible that help you in your decision-making process. The focus obviously being the T line, and then the other patterns that you're looking for, because the questions that are coming in, for example, is like the 34 EMA blue line is acting like a secondary T line. What is the relationship between the T line and the secondary T line? And when do you pay attention to one and not the other? How does that all come together in your mind, Steve?
You're not using the 50, the blue line, or the red line to make your decisions. You're using those to see what everybody else's decisions are.
Ah, okay.
So a lot of people say, well, don't you take into consideration any of the fundamentals of a company? And the answer is no, because prices do not move based upon fundamentals. How many times have we seen situations where a company has absolutely no fundamentals and it's skyrocketing? So the other part of that is, if everybody's buying down here, or we see a buy signal, that's because everybody that has done their research based upon their analysis of the fundamentals are buying. All we're being demonstrated is that they are buying. for whatever reason. It could be fundamentals, it could be expected news, it could be anything you can think of.
Sure.
That's telling us there's a buy signal in the oversold area. The probabilities are in our favor. It's time to start buying.
Excellent. Thank you, Steve. I think that catches us up with questions.
Okay. All right. So I forgot where we were, but anyways, what I was making good money using candlesticks. Let me backtrack. I could take off the 50 and the 200. The 34 works well. Now, as you can see, I hope you can see that my charts aren't that cluttered, but I could basically take off all the moving averages except for the T-line and the stochastics, because the most relevant information that we're getting as far as reversals is the signal itself. The T-line becomes now a confirmation and the stochastics become a confirmation. The other moving averages you put on here are just targets that that everybody else has on their charts, so we can see exactly what's happening at those levels. I can see what patterns are going to produce extremely high probability results, mainly because human nature works the same way time after time. I know that even though I'm up here in the overbought area, I could be buying on this day, or I could be buying on this day, because I know what the result of this is actually a J-hook pattern, which is a strong price move, a pullback, and then the next strong price move. And we call it a bobble versus a J-hook because we could see exactly where it sold off and exactly where it broke out. So a bobble pattern is just a much more defined J-hook pattern. And we know what to expect on a J-hook pattern. This wave right here is going to be the same magnitude as this wave right here. So if you're a day trader, you know you have a high probability of getting in early and knowing it's going to move in the direction that you expect it to. If you're an option trader, you're buying at the most optimal times, getting ready for the next price move. So again, the T-line is just an enhancement of what the signals are telling you, and then how long to stay in that trend. So I guess this is what we've got as a package. This package we're making available that kind of clearly illustrates what the T-line patterns are. The T-line crunch we didn't get into, or the slow curve. These are all extremely high probability trade setups. So every time I put on a trade, I don't have to worry about what all the rhetoric is out on the news stations or somebody's opinion. That's the nice thing about candlestick analysis, is it is not the graphic depiction of people's expectations or projections or their I'm trying to think, prognosis of what the market's doing. It is the actual result of everybody buying and selling. So all we're analyzing is what are people doing right now. Okay, so I know I'm done a little bit early. I thought I had a bunch more charts to show, but yeah, are there any further questions?
Okay, guys, we got Steve here for a few more minutes here. And okay, so so a lot of questions about the measurements. What are the T3 measurements?
The 3T line is a 3 exponential moving average.
Okay.
So we use that in conjunction with the T line. That if you see a buy signal and the 3T line comes up through the T line, that's just added confirmation that just another little fluffy added confirmation that you're now in an uptrend. And the other part is if it moves too far too fast, then the T line or the 3T line becomes a little bit more effective to say if you see a sell signal and it closed below the 3T line, more than likely they're coming back down to the T line.
Sure. Interesting question that was here that came in a little bit earlier. You talked about, one of the most predictable indicators was like human emotion, and had several people type in, what do you mean by human emotion?
Humans do the same thing time after time, and that was illustrated when where the Japanese rice traders tell us where do most people buy. They buy exuberantly at the top, or they panic sell at the bottom. So that's the human emotions. That's the normal trading environment when people are putting their money on the line. So what the graphics, the candlestick does is it illustrates what most people do. So and that's where I became a good candlestick investor, because I could see graphically where I was normally selling, which was panic selling at the bottom.
Sure.
So all I had to do was make just a simple deduction that if I did the opposite of what I was doing, the question always has to be, when there's terrible news and everybody's selling off a stock hard and it hits bottom, who is buying? And it's usually the smart money.
Sure.
Or when a stock is skyrocketing, going through the roof. Let me see if I can go back up to the Tesla chart. I don't know how far up it was, but people were just buying it. I mean, you could see it on your, or even on something like this. What do you think everybody is doing? They're just buying exuberantly up here. But we've got indicators that tell us when it's too exuberant, because you're that far away from the T-line.
So another somewhat of a related question here, Steve. Have you noticed over time that there's been any kind of an impact, or what the impact of high frequency traders? And
no, everybody says, well, what about all the computer generated trades?
sure,
you got to remember who programmed the computer formula for when they're going to buy and sell. Humans. So all the formulas that are put into a computer generated program, it's still the influence of human nature.
Human nature, the fear and greed. Yeah.
That's right. I'm gonna, while we're talking, see if I can find the, because we had people in our options room make lots of money closing out Tesla when it was skyrocketing. And this is where you can make, this is where this makes a lot of sense. We know what should happen coming out of a fry pan bottom, a strong price move. But most people's emotions are, boy, I've got a good profit. I'm going to go ahead and take it, which has nothing to do with what human nature is doing as far as that trend.
Okay.
So it's most, what do most people do when they buy a stock and it goes the opposite direction, it goes down? They're going to hold it until it comes back up to where they bought it.
Sure.
Which has absolutely nothing to do with what the stock price is going to do. So when do they sell it? They sell it at the bottom when they can't stand the pain anymore. Or they buy it and it goes up a little bit, and what are they worried about? It's going back to a loss. So they sell it out quickly. So that's called eating like a bird and pooping like an elephant. So what candlestick analysis does for us is it just keeps us in that trend until it's time to sell.
That you've got to make an indicator for that. The eating like a bird, pooping like an elephant needs to be.
I think that's been around for years. I'm trying to find the Tesla chart right now. That
while you're doing that, there's another question here. Several people have asked, do you ever pay attention to volume at all, Steve, or do you just let the charts speak for themselves?
No, my trading universe is I'm looking for stocks that are trading greater than 5, because most brokerage firms will not margin a stock less than 5.
Okay.
And I want to trade stocks that trade more than 200,000 shares a day on average.
Okay.
For 2 reasons. One, I want to get in and out easily. If I make my decision to get out, I want to hit the sell button and close it out without having to wait 5, 10, 15 minutes for them to execute that trade.
Sure.
And 2, the more volume you have, meaning more than 200,000 shares a day, the faster the signals will set up to show you what's happening.
Okay.
And a lot of people say, Well, I want to see the volume goes up as the price goes up. Volume and price have absolutely nothing to do with each other. If a stock's going up and nobody's willing to sell it, that stock's going to go up faster because nobody's selling it. Now, I forget why I was coming back here to
I think you were we were talking about human emotions, and you were saying that options traders were bailing on Tesla. That you
oh,
wanted
yeah.
to show that
So,
slide?
yeah.
Yeah.
So what do you think the emotions were here? Everybody couldn't wait to get into Tesla. It was just skyrocketing. And so what was our indicator? Oh man, they were still buying, they're still buying, they're still buying. So what are we looking for when that turns around? So we had option trades stopping out or closing out way up here with huge profits. And then look what happens to human nature when the herd turns around. It went down quite a few hundred points from that level.
Sure. Steve, one last question here. Let me take a look what we got. Oh, yeah, question here. Several people are asking. He noted that Jeffrey Gibby, who was on earlier, said that, you know, your stuff was loaded on the Metastock. Are there any other platforms?
I don't know whether we're on Ninja Trader. I always tell people about Metastock. There's one major disadvantage about Metastock. It has so many good stuff, so much good stuff on it. You can't even get to it all. You could spend weekends trying to figure out all the good indicators they have on there. But the nice thing is that you've got enough information trading off of Metastock charts. We have, again, our packages there where the formulas are already built in.
Sure.
So I can see my time is pretty much up. But remember, candlestick analysis is nothing more than the identification of what's going on in human nature or investor sentiment, which is the most reliable indicator that you're going to come across in the market. So with that, I guess I should have gone back down to, I can't find last viewed. Anyways, we've got the package. I should have left it there. So, yep, let me get down here real quick. This package kind of encompasses all the aspects of the T-line. Again, this package would dramatically improve your analysis of what's going on in a price move.
All right.
All right, thank you for having me today. If you have any additional questions, just email me, steve@candlestickforum.com. Be glad to answer any questions.
That's great. Thank you so much, Steve. And